Welcome back to Asia Insurance Review's series of Fireside Chats, where we talk to global leaders of the insurance industry. I'm Paul McNamara. Today we're talking to Stephen Catlin, Chairman and CEO of Convex, a successful new entrant into the insurance and reinsurance business in London and Bermuda. Stephen is undoubtedly an insurance industry leader who's had a profound impact on the size and shape that the industry has grown into today. His CV cites over 45 years of industry experience. In 1984, he was the founder and CEO of Catlin until 2015. He was Executive Deputy Chairman of XL Catlin between 2015 and 17. And he also found time to act as the Chairman of the Association of Bermuda Insurers and Reinsurers from 2015-17. Also around the fireside today, we are fortunate enough to be joined by Farah Jaafar-Crossby, who is the CEO of the Labuan International Business and Financial Centre in Malaysia. But I really wanted to start, if I could, by asking you a question about Convex, Stephen, because I saw your results. I think last time we spoke, you were really just starting out with Convex. And here we are, after your first year, you had $1 billion in consolidated gross written premiums, sort of from a standing start almost. And I just wondered, how did that feel? What was the emotion there?
Pretty electric. I mean, quite honestly, we can't quite believe we're here. I mean, Paul and I, we sort of pinch ourselves every morning. Because our timing couldn't have been any better if we tried, actually. Now, I think we can claim that we thought through the casualty market quite carefully of what was going to happen, and I think we read that correctly. But we obviously didn't know about COVID-19. Furthermore, because of the timing of it, we've got virtually zero exposure on the direct account, and we're underweight on reinsurance probably by about 60%. So the actual cost of COVID-19 to us is significantly less than the ongoing marketplace. And frankly, that's just luck. It gave us the ability to get going. I think the two things we're most delighted about. One is to get the quality of staff we've got. We've now got 350 on the books, of which 250 or so have been employed virtually, which I can tell you is a real challenge in terms of culture and stuff like that. And we had no problem in getting people, actually. People were asking around about 75% of people who've joined asked for a job. I mean, it's bizarre. And then we wrote $650 million worth of direct business last year from a standing start. And that in itself is an amazing achievement. And is it above our expectations? It's not above our hopes, but it was above our reality, if you understand what I mean by that. You know, I don't think it's ever been done before that you can write that much direct premium in your first year of operations, because we weren't writing insurance until 1/1 of last year, for a number of reasons, not least of which we couldn't get the underwriters on board in time before that. But basically, most people we're employing, they'll be on 6 months' notice. So you've got to wait 6 months from the time you offer them a job. So we weren't really offering people jobs until sort of May time of 2019. So that meant that the first wave were on board by 1st of December. It was pretty tight to get people on boarded and then get them into the culture and into what the business plan was and all that stuff. But it's been ever so exciting, I have to say.
I can
Sorry. I went through Convex's website, and one of the things that it says is that you use technology. Was the idea behind this? It was obviously pre-COVID. So is it just a chance? How has that worked for Convex, and how do you see it moving forward?
Oh, no, we'd always planned to make use of technology. We're driving big time on digital underwriting. I got a Slack through today, this morning, saying that we've got our two first segments of business starting being written as we speak digitally. The challenge actually is when you grow that quickly, keeping the back office up to speed with the front office is real hard work. Now, we actually subcontract our back office to WNS, which is actually an Indian company. It's got about 50,000 employees and about 12 working in the insurance industry. So they are well equipped and they can gear up more quickly than we can, funnily enough, in terms of doing the back office. Having said that, that is basically a people solution. So we're throwing people at the problem. And that's what we need to do, particularly this year, to keep up. Because we can't afford to miss our quarterly reporting days, whilst at the same time driving the technology. And that's quite a handful altogether. And we're not going to be where we want to get to on technology for at least another year and a half, I don't think. But we've made real progress, and we're continuing so to do.
Can I just you mentioned I think you're up to 350 staff. One of the issues that I come across when I'm talking to insurers and reinsurers quite a lot these days is, the kind of creme de la creme, the top flight graduates coming out of unis are becoming very picky about the brands they want to work for. They don't want to work for a bank that's exploiting third world countries. They don't want to work for a manufacturer. And Convex obviously is a new brand, but how do you go about getting that core target of young people, and I'm talking about people under the age of 35, saying, yeah, I want to work there? And you're saying they're coming to you. What's the secret?
Well, we've got no legacy. The management have all been at the coalface, grew up at the coalface. So we are an underwriter-driven business, and all the senior lead team have all been in insurance for a very long time. And I think we've noticed in London in particular that London staff in the industry are probably as unhappy as they've been for a very long time, if ever. And I think that's partly because they don't feel wanted. They feel distanced from the management, and they're not certain the management understand what they're doing. And they're being dragged down with backier problems. So when you can offer an opportunity going forward, moving to new technology with a management team that's actually steeped in the business itself. Now, we've lived off the back of the Catlin culture in a way beyond what I had anticipated. I'd hoped for it, but I hadn't taken it as a given. And one thing that's become clear to me actually is you can sell a business and you can sell all your data and your systems, so you've got to start from scratch all over again, which is a ball. It's hard work. But actually to work with a company that is clearly progressive and baggage free. And look, we've had a reputation for being environmentally aware. We did the Arctic survey, then we did the Seaview survey. And we're probably going to announce another one fairly shortly, actually, hopefully. And you're absolutely right. I mean, when I was looking for a job at that age, you just wanted a job. You didn't really worry too much about what the company did or what its ethos was or whatever. But the youngsters do absolutely quiz you about what's your view of environmental issues, what's your view of sustainability, what social value do you provide? And look, we're lucky in the insurance industry because 95% of what we do in the P&C part of insurance adds value. Whereas banking, frankly, maybe 25% does. And the rest is just fee driven. And the youngsters have changed they have a much more holistic view of life. They're much more aware than I think we were when we started work. Now, if you recognize that, and can talk coherently about the subject, you immediately become attractive just by doing that.
Seems to me like the firm feels like a disruptor startup with the issue of technology, no legacy, and being able to attract the youngsters because of it. And it's fantastic.
Yeah, we try and avoid using the word disruptor. We're not there to disrupt. We're there to give good client service and added value.
Of course.
There is a hole in the marketplace. The lack of leadership within the industry today, globally, is shocking. It's the worst I've ever seen it. When I saw Denny Kessler in Monte Carlo, I think when we last met, actually, that was it 2 Septembers ago, he said to me, well, Stephen, you and I have known you for 25 years. And in those days, there were a ton of entrepreneurs around in the marketplace. Now there are very few. And I didn't think too much about that comment at the time. It's only afterwards, with hindsight, I looked back and said, you know what, Denny's right. And if you look at what's going on with COVID-19, I mean, the lack of leadership from the industry is staggering. Now, I mean, hats off to Evan Greenberg for what he's achieved stateside, without any doubt at all. And there are a number of players in Europe who are on the front foot, but there are a lot that aren't, actually. And that in itself creates opportunity, actually. So we thought we saw a hole in the marketplace. We saw a lack of leadership in London, generally speaking. We used to lead a lot, as you know. I mean, our Lloyd's syndicate was the largest for about 12 years. We led more business than any other syndicate in the room. It was 50% of what we wrote in Lloyd's we led. So we built up relationships with distribution and with the policyholder. And, you know, they stay with you, actually. And once people know that you can be trusted and they know you're going to pay your claims quickly and efficiently and fairly, you become a go-to market. And I think the surprise to us is we've getting to a go-to market very quickly. I don't think we doubted we'd get there because we've been there before. I don't think we really thought we'd get there as quickly as we appear to be getting to at the moment.
Tell me, so the kind of picking up on that brings me on to one of the questions I wanted to put to you, which is that just by dint of your experience, or for that matter, the same kind of period that Denny Kessler has, you've seen a lot of this stuff before. Maybe not quite as bad as COVID, but you've seen some pretty seismic events. The question really is, are the lessons that you picked up during that previous, trauma, whatever it might have been, that you've applied today? And that kind of brings me on to the question that sprung to mind just as you were speaking just now, which is that why the leadership that you're referring to is lacking, because it hasn't had experience, it hasn't had exposure to that kind of very difficult markets?
Yeah, well, some people refer to me as a senior citizen, which I suppose I can just about cope with. I have to admit that come October, I've done 48 years in the industry. So you're right, I've seen a lot happen. I've seen a lot happen in Lloyd's during that period. But I do think we live in unprecedented times. I mean, so Nicholas Holmes said to me, this is the most meaningful event that's happened since 1945. Well, seeing his grandfather was Winston Churchill, I guess he should know. And I think it's probably right. I mean, look, with hindsight, we should have seen or thought about the financial consequences of a global shutdown. But I don't think any of us did. And that includes governments. So, I mean, governments are on their back foot, scrabbling around trying to work out what to do. And all they're worried about is the here and now, because they haven't got time to look into the future, and they've got to deal with the here and now. So there are lots of lessons to have been learned. What happened following seepage and pollution, asbestosis, all what happened around 9/11 in terms of the then casualty crisis and an unprecedented loss, which nobody thought about before. But it's different this time around. And I think it's different primarily because of the magnitude of the losses we're faced with on an economic basis globally. And if you go back to 9/11, people have said, well, it's just like they're now, isn't it, Stephen? I said, well, yes, in part I agree with that, and in another part I don't. In those days, the casualty hole was 25 billion-ish, and it took 5 years to unwind. Actually, knowledge of it probably unwound quicker, maybe 2 years. This casualty hole is a 15-year-old hole. It's bigger, deeper, with some significant changes in risk exposure as well. Then you get COVID-19 on top of that. And look, COVID-19 has got years to run till we know where we are as an industry. One senior broker said to me the other day, a very senior broker, said, I reckon, Stephen, it's going to take 10 years to unwind. Well, I've been saying publicly 5 years at least for some time. That's the first time I've heard a broker say I think it's going to take 10 years. And one of the reasons for that is the nature of the loss and the uncertainty in terms of cover afforded. As I think you probably know, I chair this steering group for my sins in London on pandemic on a prospective basis. And we've got about 90 people involved, all pro bono, some of the finest brains in insurance looking at the problems, not just underwriters, but lawyers, claims adjusters, actuaries, the whole 9 yards. And when you try and dream up an event definition, which is legally sustainable and globally applicable, it is extraordinarily difficult to do. In fact, we haven't managed to do it. And we've come to the conclusion that we probably can't do it, it's too complex. So you've got this situation in the marketplace today where the reinsurance market is lagging the insurance market in terms of rise in price. That's the first time in 50 years, ever. And I think it's partly because the direct market is probably a bit closer to the action and the losses than the reinsurance market is. The reinsurance market most certainly isn't recognising its casualty exposure in its books. There's far more pro rata reinsurance being placed in casualty in the last 5 years than there has been in the last 20. So by volume, it's bigger. And the argument's going to go on about event is going to be messy, unfortunately. And I don't think it's going to bring our industry into anything other than disrepute. People can say, what are you up to? What are you doing? How is it you can't define what cover you're giving? But the truth of the matter is people don't know. So what's happened is, on the reinsurance side, some of these issues have been kicked into the long grass. And if you haven't recognised them on your balance sheet in terms of reserving, how can you charge price for them? You've got to recognise what you've got before you can really charge for the future. And we haven't got there yet.
The last pandemic, so when it is very scary, but then I'm thinking back to the 1920s when we had the terrible plague. Was there no definition of an event then? I mean, isn't there something that we can learn from there?
I know I'm old, but that one's before my time.
I wasn't suggesting personal experience, dare I?
I think, the reinsurance market in those days was much, much less sophisticated than it is today, and it was much smaller. So, in those days, by and large, gross was net for most things. I mean, You can go back to 1906 with the California quake and say, what are the lessons learned there? Well, one of the lessons learned there is if you pay your claims quickly, you build yourself a reputation. And I trust Heath, as opposed to Munich, who by their own admission now, and a book has been written about them, said we did not handle that situation particularly well. And they said they weren't going to pay, and then they did a volte face and started paying again, by which time, frankly, the damage was done from a reputational point of view, and it took them years to recover from that. 1920 plague, I generally don't know enough about it, actually, to really opine. But you're probably right in that from a health point of view, that was probably the last really big loss until last year. And I think, as you've asked the question, maybe I ought to do a bit of research and try and find out what actually did happen all those years ago and see if it is relevant or does give us any lessons for the future. Look, I'm a great believer in learning from the past, but you've got to make certain you don't think that past happenings are necessarily a proxy for the future.
Absolutely.
It certainly help think through, how do I handle this event? But it's not predictive in terms of what the event's going to be, or all the content, or the severity. I mean, it's a bit like looking at climate change. I mean, at the moment, climate change is not a systemic risk. Could it get there? Yeah, I think it probably could. Will it? Who knows? But it's probably 5 years away. But, you know, you're seeing losses like the Australian bushfires, California bushfires, the Texan freeze. These are losses that wouldn't have happened 10 years ago. And why is that the case? It's because of climate change. Has the industry modeled adequately to understand the effect of climate change? No, we haven't. There isn't the data to do it, actually, at the moment anyway. So I think everybody's scratching their head and saying, okay, fine, this is not looking good, it's not going in the right direction, but how bad is it?
So, Stephen, are you saying then that my initial question was going to be about the kind of variable results we've seen from some of the big reinsurers recently, but I think you've kind of changed the question slightly now to more about are the management of the big reinsurers presently too busy putting out fires, possibly caused by COVID or bushfires, to be focused on strategizing a new way of doing business?
Well, it's not for me to comment on the management of other companies in the sector. That would be wrong, I think. What I will say, though, is that one of the advantages that we have at Convex is that 80% plus of our time and our management time is spent looking forward. Whereas for many other companies, 80% of their time is spent looking backwards. And is there a competitive advantage for spending more man hours looking forward? I think the answer to that is there must be.
Very good. Which kind of brings me on to there was one of the AM Best rating note that came out, I think yesterday or the day before. It said Convex faces strong competition in its target markets, and I sort of wondered to myself, does it? I mean, it faces competition, but is it? Bearing in mind what you've said about reputation and place in the market and how you approach things.
Well, look, we've just been through, as you've commented on, we've just been through the next round with AM Best. We've just completed the next round with S&P only yesterday evening, actually. And they've both said to us, actually, slightly to our surprise, you have absolutely achieved what you set out to do. And both of them said that their committees were on the cynical side of our ability to deliver what we said we were going to do. So we kind of got a tick in the box from them from that perspective. It is a competitive marketplace. It's still a competitive marketplace. And at the moment, there's plenty of capital out there to write business. Now, whether that capital is for real or whether it's actually pseudo capital in the sense that it's really needed for reserving, time will tell. But today the market is competitive. And the way you get business and keep it is by giving a good service to distribution, the broker, and by giving good and fair service to the policyholder. And if you can live on a prior reputation of doing just that, it makes a huge difference for the future. But it'd be wrong to think this is not competitive. Pricing is going up, which is good. Have we got to where we need to get to? No. Are we nearly there in some classes of business? Yes. Are we miles away in other product lines? Yes, we are still. So there's a lot of remedial action to be taken, actually. And as that goes on, people are fighting like hell to keep their position in the marketplace, and can lose sight of what the job is, which is actually to give their shareholders a good return on capital.
How do you intend to take this forward? I mean, sometimes, when you look at a situation and you've done so well so quickly, the pressure is on. What are your thoughts about how you're going to take this forward and continue this momentum?
Well, it's a good question. It's a little. We have set ourselves a very high hurdle, almost inadvertently, actually, and we have found ourselves in a profile at this moment in time we hadn't expected, and that does increase the pressure to succeed, without doubt. Have we finished? No, we haven't. Are there many opportunities in the future? Yes, there are. Look, risk around the world is increasing. And I think that's one thing people will agree on. So we're in a marketplace where our product is of its own volition growing. There's more risk around now than there was 10, 15, 20 years ago. And it doesn't all get insured, but quite a bit does. And therefore demand for the product is going up. The risk is going up. The risk is changing. When I started nearly 50 years ago, most companies were insuring physical assets with 90% of their balance sheet. Nowadays, for many companies, physical assets are no more than 20% of the balance sheet. So the actual exposures they have are not about property damage per se. It's about loss of reputation, loss of brand awareness, loss of delivery of product. The world is changing. That's what makes it so exciting, because in a changing world, there are always new challenges.
If I could come back to something you said a minute or two ago there about relationship with brokers, which are clearly very, very important to Convex and many others. I just wonder, how do you see the role of the broker changing in the next couple of years or 5 years, and how do you see your relationship with brokers changing in that similar kind of period? Is that an act of an evolving kind of symbiosis where you depend upon each other?
Yeah, I would hope that our relationship with brokers continues to improve. We spent years working in those relationships. We're not about to let go now. Whatever some people say, they provide a very useful service as an intermediary. They can give their client, the policyholder, independent opinion, which I can't do because I'm selling the Convex product. And therefore, de facto, I'm not independent because I'm only selling one product, and that's the company I work for. Whereas brokers operate with many different carriers of different shapes and sizes, and they have choice as to where they go, and therefore they have choice of product they can offer to their client. So in my view, the underwriter can never replicate that. Now, when you get down to commodity business, it's a different issue. What is the role of the broker in commodity? And that's certainly different to what it was. And there have been far too many snouts in the trough in terms of take in the middle. so that what the policyholder pays and what the underwriter receives is really quite small. And I think most policyholders, if they realised how much money went in the middle, they wouldn't be very happy. So I think that end of the market is going to change, and disintermediation is probably going to happen. But it's quite a different skill set to the one we have. I mean, we don't claim to be volume personal line underwriters. We're not geared up for that. We never have been geared up for it. And you have to have different disciplines to be successful at that game. And you look at some of the motor carriers in the States, for example, the ones that have moved forward have got a better portfolio than the ones that stay stationary, in terms of how they distribute and how they deliver the product they're offering. I think when you get to a specialty business, by its nature, it's not a commodity. It requires human intervention. The question is, though, how much intervention is required, which is human? And what can we digitize? How can we use AI et al. To cut out unnecessary human interaction? Because that's cost money. And actually, the computer does a better job. The less errors come from the computer than the earlier when compared to human error. But I actually don't see anytime soon the role of the broker on specialty business going upwards materially changing. Do they have to move forward in technology? Yes. Do they have to cut the cost of their process? Yes. Do they have to be more efficient? Yes. Guess what? So does their client, so does the carrier. We're all in the same boat, actually. All trying to do the same thing in our own way. And I think there will be winners and losers on the broking side, in the same way there's going to be winners and losers on the carrier side. And part of that is going to be expense or lack of control of expense. And part of that will be lack of automation and lack of use of technology. So if you're not keeping up to speed, and gosh, I mean, technology is changing at such a pace. We have a thing in Convex called Henry, and you can ask Henry to do virtually what you want, including reading a slip for you, finding the data on the slip, comparing clauses, and spewing it out the other end. Stuff that used to take hours of human intervention, subject to human error, can now not be done in a nanosecond, but can be done hugely more quickly, more accurately, at far less expense. Now, if you're not taking advantage of that expense saving, you're going to suffer.
So it's almost as if for specialty business like Convex, what Convex is in, you need a fine balance between, let's say, AI technology and that human touch.
Yes.
And maybe that's clearly the secret of your success. And the idea that there is going to be a middle ground in that space.
Well, your word success, not mine, but thank you. It's a continual long journey. It's a journey that's going to go on for some years, for everybody. Our job at Convex is to get ahead of the curve. Mm. And it is somewhat easier for us because we don't have legacy of claim or process. And as I said earlier on, we have the time management-wise to look forward most of the time rather than looking backwards the whole time. So, frankly, if Convex doesn't succeed in this environment, more fool us. Mm. That would be our fault.
Yes, I understand that. If I had to be cheeky, and I always do, how many % would be Henry and how many % would be human?
I don't know the answer to that question. But I think we think that human intervention will decrease significantly, and it's already doing so. And maybe cuts out 65% of human intervention. I mean, it's big. And it's going to have a societal impact. When I look around here in the city and I see all these cranes around, I'm thinking, how does that work? Why do people think we're going to have more and more people coming to the city?
Okay.
Because why would you want to employ people in the city to do menial tasks? It's one of the most expensive places in the world to employ people, one of the most expensive places in the world to rent property. Why would you want to do that? And I think the working population is going to be challenged as to what their jobs are in the future. When I guess when Paul, you and I started our careers, we could see a path as to what we might do, and we didn't think really that our job or the role that we were fulfilling was going to be fundamentally questioned. That isn't the case today. I mean, how many people stay in one job for a lifetime? Very few nowadays. How many people have to re-educate? Maybe at least half of the working population.
For sure. But it's intriguing that you say even within your specialty lines, you're looking at 65% of Henry. So in a more commoditized line, it will be even higher, presumably.
Oh, yeah. Yeah.
So, Steve, in terms of
85%.
In terms of future business growth for Convex, and you're in all sorts of areas like marine and aerospace and casualty and property and so on, do you kind of get up and on a quarterly basis or a half yearly or annual basis plot which of those business lines you think are kind of ripe for growth, or is it just a question of watching what the market tells you and then jumping on it?
Well, when we do our business plan every year, we have to look forward and try and second guess what's going to happen to each individual product line. Whereas there like to be more margin, whereas there like to be less margin, when is that product becoming unwritable? When is it time to expand on the product line? I think most people take a really hard look once a year, and then most people will look at it and view it quickly in less detail just to sense check whether their assumptions were correct. But the need for risk transfer doesn't go away. Now, the main role that a carrier plays is to free up capital for their policyholder to reinvest in their own business by taking risk off their balance sheet at a price that saves them money at an adequate price to give our shareholders a return for the risks they're taking. That fundamental hasn't changed. And all the time I've been involved in insurance, I doubt it will change, but that fundamental is still there.
Yeah, excellent. That brings me on to quite a complicated question, I guess. You mentioned a short time ago that really what it's all about is, return on capital. And I'm wondering if you're looking at new markets or new lines, how you go about establishing what your base is. If it's below X, it's just not going to work out for us. And really where I'm headed with this question is if you were looking at specific geographies, and you thought there was a political risk in that geography, how do you factor in the fact that actually that's not quite as stable as, say, Europe or the UK or, more mature markets? Is there a process where you go by, where you kind of put a premium on certain markets and say, no, it's just not worth our while going in there?
Well, generally speaking, it's all down to price. Can you charge adequate price for the risk you're taking? And is the political risk, credit risk different around the globe? Yes, always has been, always will be. And does it go up and down in geographical areas? Yes, always has done, I think always will do. We're living in some pretty uncertain economic scenarios at the moment, both on a global basis and on a regional basis. And you're seeing lots of fights with the bigger countries against each other, China versus America. in the way that we haven't experienced heretofore. That challenge isn't going to go away. In fact, that challenge will increase as the world. I mean, the world has, in a sense, has become a bigger place, but on the other hand, it's also become a smaller place. The interdependency between regions is huge now, far more so than it used to be. So quite a lot of these issues are not just geographical, but they're global. Trying to understand where the economies are going, what the market forces are, where the opportunities are for business. Because look, insurance carriers live off successful businesses. And if you ask me, what's my favorite client? A successful business that is growing, that understands risk management, and risk mitigation, understands the role that the insurer can play in terms of supporting his balance sheet. That's my ideal client. That we then, at the get-go, speak the same language.
Absolutely. So we've probably only got about time for another maybe 2 questions. Farah, if you have one, I'll try one.
Yeah, I have a very simple question. 48 years ago, when you started in this business, did you ever think, number one, you'd be where you are, building businesses, successful businesses within such a competitive environment, number one? Number two, if there's one thing your past self could tell your future self, what would it be?
Well, to your first question, I had no idea. And in fact, if you told me this is what's going to happen 48 years ago, I would have said you're smoking dope. That ain't going to happen. When I went into Lloyd's in October 73, I was shocked at the inefficiencies of the system. I was shocked at the lack of analysis of the data. I was shocked at the mechanisms of pricing. I thought this can't be right. Then the longer I stayed in the industry, the more I realized it was right. And as I came to realize that, then the opportunity in my mind increased. But if you asked me when we set up Catlin in '84, did I think we'd be selling it for $4.3 billion 30 years later? I said, no, not a chance. And if you said to me even 5 years ago, you'll be setting up a new company, you will have raised $3.2 billion and you're going to be close to where you got to when you sold to Excel. I said to you, not a chance. But if you seek out opportunities, they find you. And the trick of it is to realize the opportunity. At the end of the day, I do work for our shareholders. That $3.2 billion didn't just fall from the sky. Those guys have invested in Convex, in the management team of Convex, in the belief that we can give them a decent return. They haven't invested because they love us or like us. It helps if they like us, but they are investors, and that's their job. In the same way as I'm an underwriter, and that's my job.
Okay, so the final question, Stephen, is I think it was probably 2 years ago or 2.5 years ago when we last met, and Convex was at the start of this amazing experience that it's been through. If you were to imagine we were sitting, all three of us, in 2 years' time, how do you think Convex look different in 2 years to the way it does today?
Well, that I don't know. I would hope that we haven't fallen off the pedestal during that period in time. I would hope we strengthened our position and our relationship with brokers and clients. I would hope that we further established our leadership position. And I will hope we're making a difference. I mean, I've got to the stage now in my career where the most important thing to me isn't to make money per se. That's a sort of almost a byproduct. It's to make a difference. And I think we're very fortunate in our industry to be involved in an industry that can make a difference, that can be socially aware, that can encourage sustainability and best practice. Looking back, I think if one's actually made a difference, the concept of global warming climate change was not accepted by many people. And one of the reasons we did that was we think there's something going on. We're not scientists, but let's help the scientists get the data to find out. Same thing with the Seaview survey. People then didn't recognize that actually we are losing coal around the world at an alarming rate. There's half now what there was 15 years ago. And, it's the start of the seafood chain for many species. I mean, it's serious. And I think, on the way through, if one can actually be at the forefront of awareness, and therefore from that awareness make a difference, to me, I would say, well, that is an achievement.